This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Thanks for joining us. Super excited today to have Kevin Muir with us. He is the author of the MacroTourist newsletter. He's also an independent trader based in Canada. Kevin, what's up?
It's great to be here with you today, Jonah.
Thanks for joining us, man. So it's been a long week. Tell us about your week. What are you trading right now?
Well, it has been a long week. A lot of people I've noticed are frustrated with the action. There's just seems to be it's when the bulls kind of seem to get
we're just going like sideways, choppy. Market can't decide, right?
I kind of been saying this for the last little while that 2023 is going to be a year that frustrates both the bulls and the bears, and so far that's actually coming, true in terms of it just doesn't seem to want to go anywhere. And then I think what the real problem is that there's a lack of liquidity out there right now. And increasingly there's this fight in terms of like, are we going to go into a recession? Aren't we going to go into a recession? One day it looks like we're going to go into a recession, and they all put on the recession trade, and you see these monster movements within the market. And then the next day you get something that goes the other way. And I think traders are left with just this kind of, they're feeling despondent, beat up. And I don't know anybody that's really going, this is a terrific market. Everything's great. I'm loving this action.
What do you typically trade? Is it equities, currencies, futures?
So I trade a mix of everything. So I've been doing this. I was actually the institutional equity derivatives trader at RBC in the 90s. And I quit when I was fairly young. And since then, I've just been trading my own account. And people always say, like, what do you focus on? What do you make your money on? What's your specialty? And my specialty is that I have no specialty. And whatever I think that there's an opportunity, and I will go to. So one of the examples I like to give is in 2015, the first time oil came down, there was a big oil bear market. I got bullish, probably too early as usual. And I started looking at different things to buy. So I go look at the futures, and the futures are trading. The forward futures are trading at this big premium to spot. And I'm like, oh, I'm going to have to be so right to get that correct. Then I go look at the equities, and the equities are trading basically like call options, because what's happened is the price of the oil's come down so much that we've gone through a lot of the equity, and then actually the bonds are trading at 50 cents on the dollar. So that year I decided, okay, well, if I'm wrong about this, I'm going to I'll go out, I'll get bullish on oil. If I'm wrong about this and I buy the bonds, what's going to happen is that I'll get the next round of equity and I'll just stick around. So I started just trading, corporate, oil bonds during that period. And it was just ended up being a lot better risk reward. And so over the years, I've traded a variety of different things. I like batting around S&P futures as much as the next guy. But I would say that one of my strengths is the ability to go wherever I see opportunities.
Where do you see the most opportunity right now?
Well, I guess for the last 4 or 5 years, I've really believed that there was a secular change in terms of inflation. And I was beating this drum for a while. And when everyone was telling me in 2018 and 2019 that inflation was something that deflation and disinflation was something that was inevitable. And what they cited were what I call the 3 Ds. They called it the demographics, the aging demographics, the amount of debt that was out there, and then disinflation due to technology. There was just this belief that we were going to have disinflation forever. And I know it seems funny now, and everyone seems to have forgotten it, but I remember talking about this in 18 and 19, and people, real serious hedge fund managers, taking me aside and telling me there was no way we were ever going to have inflation. And ultimately, it ended up being...
defense, I mean, it seems like every CPI report now is this big deal. I mean, there were many years where no one even paid attention to CPI reports because they weren't volatile.
And yes, and to their defense, inflation was not a problem. And in fact, inflation was a problem the other way. And one of kind of my pushbacks to them was that they thought that this was inevitable, that this was the way we were headed. And I always said that the main reason we were having this disinflation was because we were trying to use monetary policy to stimulate the economy. And there reaches a point where you go and you can't, you hit the zero bound, and then you go out and you try unconventional measures to stimulate the economy, and it doesn't work. And I look back at, like, from 1982 all the way to 2009, they just kept lowering rates. Every recession, if you look at it, every recession had a decline to a new low in terms of interest rates. And then this ensuing rally, meaning the expansion on the other side, it took less of a increase in interest rates for it to finally turn over the economy. And it was because we were trying to rely solely on monetary policy to stimulate the economy. So the economy gets into trouble. They go and they lower rates, and they try to convince people to buy more house, to buy another car, and do all these things. So they do this and do this and do this until finally they hit a point where you put rates to zero and everyone's already borrowed enough. And we're like, holy shit, this isn't going to work. They try QE, which everyone freaked out about and thought it was going to be inflationary. It doesn't, it's not inflationary. And we can talk about why that is. And then we hit this next 10 years where people thought that there was no way to create inflation. And I've always said that if there's the political will to create inflation, we can do it. And what it comes down to is the fact that I believe that people mistakenly believe that governments are like households, and that there's a limit to how much debt they can create and how much they can spend. And there really is no limit. The limit is that once they create too much debt and they spend too much, it creates inflation. And so I always argued that the inflation was inevitable, and it would actually be, once we figured out this point, that we would abuse it. And I think that's what we're seeing now, because in essence, once COVID came, they realized that they were going to try to solve this. They did do monetary stimulus. But as we saw during the great financial crisis, monetary stimulus on its own isn't inflationary. But yet they did monetary stimulus with huge spending. And so now we've gone into this environment where we have inflation. And yes, it's ticking down and we're going back lower. And there's no doubt about it, because there was elements of it where there were supply constrained. Like, it was a supply side problem to some of it. And those problems are getting fixed. But I really believe that something changed in 2020. And what changed was government's willingness to use fiscal stimulus as a way to revive the economy. And if you kind of take that to the next conclusion, I believe that we're headed into an environment where, yes, there will be times when inflation goes back down, but we're not returning to the sub 2% that we saw from 2009 to 2020. And therefore, investors, traders, and everyone, they're using a playbook that they've used for the last kind of 20 years that's wrong, and it doesn't work anymore. And I think that that's the biggest challenge that people are facing right now.
Do you think the FOMC can get inflation, whether it's headline or core CPI, under 2% in the next 6 months?
Yeah, so I think that they can. If you go look at the forward inflation swaps, they're already almost at 2%, like 3 or 4 months out. So do I think that they're able to get it down there? Not a problem. What I think what's going to happen is, and if you look back to the 70s or maybe even the 40s, like after the war, when we came out of it, we had these spikes up and down in inflation. So you go up to 8 and then you come back down to 2 and then you're back up to 8. And it's just this environment of this benign inflation for a decade was the unusual part. And so I think that that's increasingly what we're going to see. And I think that there's lots of kind of consequences to that. One of the things that I always said to folks back, before 2020 was, I said, be careful with your assumption that the bonds in your portfolio are going to be a ballast to your equity, to your risky portfolio. Because for the last 40 years, they have been. Like, it was the greatest trade ever. Ray Dalio became the richest hedge fund manager of all time, basically taking advantage of risk parity. And risk parity was like, they would go and they would buy equities and then they would buy bonds, and they would actually lever them up so that they were equal volatility, or at least closer to equal volatility. And when the stocks got into trouble, the great thing about it was that the bonds were negatively correlated. And so you had this decline in stocks, but yet your bond portfolio saved you. And then in the meantime, bonds from 1982 all the way to 2020 were on this downward trajectory from 15% in 1982 or whatever they were, all the way down to practically zero. So it was the best of both worlds, and it ended up being a terrific trade. But in 2020, when they finally switched from using monetary stimulus exclusively to monetary and fiscal stimulus, we saw that the stock bond relationship, that correlation, flipped from negative to positive. And that is a big, big, important problem. And that's why you saw the 60-40 have the worst year in 80 years or something like that?
Yeah, maybe ever. Yeah.
Yeah. It was brutal. And I think that that's really the biggest challenge is facing investors is this idea of how do I construct a portfolio if I'm going to have bonds hurting me at the same time that my stocks are hurting? And I think that it is very difficult. There's some different things that, that people do. They put in commodities, they put in some gold, and they try to do different things like that. I actually think that more traders should be going and looking at tips. And a lot of people say, well, tips, they're the problem with them is they're still a bond and they move up and down with interest rates. Yes. But if you do something called break evens, where you actually short the bond on the other side, you can create a structure a security payoff profile that in essence is giving you the returns of inflation. And sorry, go ahead.
I was just going to say, I've been looking at some of those, the ETFs. I think JP Morgan has a couple, the call option writing ETFs where they own the underlying securities and then they sell the options to generate some income. I mean, is that an alternative for some people rather than owning bonds?
So I actually don't think that that's a very good strategy. What you're in essence doing is giving away all the upside and taking all the downside. And you're doing it in an environment where you're not really getting paid because you're selling out of the money calls on the upside, which you're not really getting a great implied volatility for. And so it's kind of you can chip away. And then what happens is finally you get a big whoosh and you lose it all. So in general, I don't like those strategies. I think that they end up hurting people, and I get it that it feels attractive because it feels like, I'll earn more of a yield and stuff like that. I always just kind of laugh and say there really is nothing for free. So if something seems like it's too good to be true, it probably is too good to be true.
Where have you made the most money trading? Or do you know what's your favorite thing to trade? I mean, do you like equities? Would you buy fixed income here right now with the 10-year back above 3.5 or 3.6? I haven't looked at it yet in the last few hours, but
yeah, I kind of laugh. I'm the world's biggest bond bear. I think that eventually we're going to have a situation where the yield curve, meaning the difference between the short and the long end, is at record wides because people realize that inflation is a longer term problem, and therefore, what's the point of giving the government your money for a longer period of time to have them inflated away on you? And that's ultimately what I think is the problem. From kind of trading the squiggles around, do I think that you could buy bonds here at 360 or whatever they are and get it, and you can get a rally down to 320? Sure. I think that can happen. I don't think it's a long-term great trend idea. And I actually, interestingly enough, I think that if you look back to 1982, when Volcker broke the back of inflation, we had a time, I can't remember the exact numbers, but let's say inflation was 10% or 9%. It actually very quickly declined to 2 and 3%. And yet the 10-year stayed high for 3, 4, 5 years as everyone assumed inflation was going to come back. So in essence, the real yield, meaning the yield you earned on top of inflation, was high. And I think that there's and again, that was because people were scared about inflation coming back. They had just experienced a decade of inflation being a problem, and it seemed like he might have fixed it, but they were more scared about it coming back than they were about locking in their money at the time. To me, this feels almost like the reverse Volcker moment. We have a situation where we just had inflation at 8-9%, and yet the 10-year was negative in terms of like it didn't yield a positive real yield, and it was like what 4%, 370 or something was the high. It never really got worried about inflation. And I think that because in most investors' minds, we're returning back to that 2010 to 2020 period. And I think that's what everyone's expecting. So even though I understand the long history of the yield curve giving great signals for the economy and for forecasting recessions, a little part of me is worried that the yield curve is inverted because everyone's so quick to assume we're going back to that 2010 to 20 period. And if we don't, and if there was a secular change, then you could see a situation where that 10-year goes from 360 and next thing you know, it's 4 or 5%. Like go look at the 10-year before 2009, and you'll be surprised that it actually was consistently higher for a long period of time. So take out the post GFC thing, which I think was an anomaly that was created from excessive monetary policy without understanding fiscal policy, and assuming that we continue to spend, which I think we are going to continue to spend, then what you're going to find is that the 10-year bonds don't save you like you might think they're going to save you.
Okay. How would you grade Powell and the FOMC over the past 2.5 years?
So I think he's terrible, and I think he's good, but I'm a little different about why I think he's terrible than most people. Like some people think, oh, he's terrible because he's too hawkish, or he's terrible because he's too dovish. I have neither one of those complaints. I think he's terrible because he has been inconsistent. And like, I just remember him coming out, and when he first took over the fall of 2018, he came out and he gave all sorts of speeches about how he was there for the great financial crisis cleanup. It's really terrible to have a situation where you're cleaning up and making, cleaning up after the fact. It's better to nip the problem in the bud ahead of time. And he got really hawkish, and he really convinced people that he was going to be, tough on the market. Then what happened was he went and he said, remember that his famous comment, we're a long way from neutral, and the market just shit the bed. And we had that
late 2018.
Yeah. So we had that Christmas Eve massacre where the thing just went boom, and then he just completely gave up and went and flipped the other way. Okay. Then from there on, if you looked at him, he was actually relatively dovish. And then during the COVID issues, I would say on the whole, he was fine. His response to COVID, it was extraordinary. People don't understand how messed up the markets were. He probably needed to do all those things. So I would say that the first, 6-9 months, I have no problems with what he did there. Where I have a problem is he then, and I just want to backtrack a little bit. Even during, before COVID, he was talking about the flexible average inflation targeting. And what flexible average inflation targeting is the idea that if you're running a 2% target and you're 1.5 for 5 years, then you have to run 2.5 for another 5 years to catch up to where you were, or something like that nature. So he was talking about this flexible average inflation target. And at that point, he actually seemed like the most dovish central banker that we've ever had. He was talking about targeting unemployment in certain groups, not just as a general whole, talking about certain groups. He was talking about flexible average inflation target. He was as dovish as they came. Then COVID happens. He does everything. That's great. And one of my complaints then is that he goes and he eventually flips. And he flips and he goes from being the most dovish to the most crazy hawkish. And not only that, along the way, I think he made a very big mistake, and it comes down to plumbing. They had guided that the QE was going to take a certain amount of time. They had said, okay, it's going to be till, I can't remember, December of 2020 or 2021. No, it's 2021. They guided and said that QE was going to go till the end of December 2021. And everyone at one point knew that they should be raising rates. And yet he refused to raise rates. And his argument was that we basically are still doing QE, which they view as stimulative. Therefore, we shouldn't be also raising rates at the same time. And like it was the old like sucking and blowing at the same time. It was such a stupid argument, and it was such an obvious mistake. He could have finished out his QE, just left it and bought it. There was nothing from a plumbing perspective that made it so he couldn't raise rates. That was a completely self-imposed arbitrary rule that he put on them and the Federal Reserve. And I think it was a horrible mistake. And then after that, he realizes, oh shit, I've made a huge mistake. I'm way behind the curve on inflation. And he just goes
and that was right after all these banks had bought, lots of
treasuries. Well, listen, those I don't have a lot of sympathy for those banks that messed up and bought all those things.
Well, they weren't hedged, right?
JP Morgan didn't do that. JP Morgan didn't do that. And I remember Jamie Dimon getting on TV saying rates can go higher. They can go a lot higher. And in fact, if you go into the Eurodollar market, which is like the front end of the bond market's pit, there was a bid for puts, meaning people that were betting on higher rates. There was a bid in that market for 6 months that was just absolutely massive. And they would buy whatever was offered in terms of buying puts, meaning buying protection. I am completely convinced that was JP Morgan realizing that there was the chance of much higher rates and hedging their book. So I am not sympathetic to these bankers that went out, loaded up on bonds at 2% and then got mad at Powell. I'm not mad. I'm not frustrated with that at all. I guess where I would say is that I think Powell has been a little too aggressive in terms of his getting here. I would have been more like we definitely needed to do 50s. Whether we needed to do 75, I don't know. I think he could have taken his time to get here. I think that he is in this right now is likely overdoing it in terms of it's like one of the things that about inflation that kind of just cracks me up is that everyone's looking at year over year inflation. And so don't forget, on the year over year inflation is all the previous 11 months of inflation. So you could have, if you look at the last 6 months, for example, we actually have inflation that's not that far off of 2%.
Oh, yeah, right.
Right? Like if you just if you annualize the last 6 months. So to me,
because we're probably averaging plus 2% month over month for the last 6 months.
Yeah, it's like 2 or 2.5, and it depends on which one you're doing and how you go about doing it. But inflation is no longer the problem that they think it is. Yet he's looking at the year over year numbers, going, "Oh, we're still in negative real interest rates," and I'm like, you're not in negative real interest rates. And the thing that pisses me off about that is if you actually wanted to look at your policy rate, all he needs to do is go look at his Fed funds. Here, I'll just pull this up while we're doing this because it's a good exercise. So he's got Fed funds at, what is it right now? Let's just FDTR. I'm just going to pull it up here. So Fed funds are 487, 488, roughly mid-market, okay? But if you go look at the inflation swap, meaning where the market is expecting the next year's inflation, I'll just tell you, it's got the 1-year inflation swap at 243.
Wow. So
if you're looking at where the policy is versus forward expectations of inflation, it's positive 250 basis points already. So he says there, and he says, well, no, our interest rates are negative. I go, no, they're not. And they were negative. There was a period where he was below the inflation swap. And when that was the case, he did have to catch up and he did have to do it. But he's like, what's there's some line that I think Milton Friedman talked about, and they talked about central banks being the fool in the shower. And meaning that they turn the knob way up, and then all of a sudden they're waiting, and then the hot water scalds them, and then they turn it way down. And that's in essence, I feel like
I always talk about the pendulum swinging too far, right?
Yeah,
go too far in both directions.
So like that to me, that's my complaint about Powell is that he's volatile on both sides, and I feel like he could just relax a little bit on both ways. He didn't need to be as dovish as he was, and he didn't need to be as hawkish as he was.
I mean, what's the point in going another 25 basis points when you know that the bank failures created stress in the system, tighter lending standards? They're still doing QT, right? There's still a lag effect to all of the previous rate hikes that we haven't even seen yet. Like, what is the point in going another 25 basis points? I just don't understand it.
He's so scared about being another Arthur Burns, and he basically just wants to kill it. Like, I personally think what's going to happen is he's going to go and get inflation down to 2% and tap out. I think he just wants to get inflation down to 2%, say, I achieved my goal. I wasn't Arthur Burns. Now I want out of this. Like, I really do. I really think that's the case.
When you say tap out, like retire?
Yeah.
Oh,
yeah. Like, I think he's good. Sorry, I didn't. Yeah, I think he just wants. I think he just wants out. I really do. I think that but he does not want to leave without it being 2%.
I mean, he looks 20 years older now than when he took the job.
Oh, it's a tough job, to be fair. I'm giving him a hard time, but I'm sympathetic to the fact that he's got to go and wrangle, 15 board members. Right. And then
who all love to get out there and talk and let.
That's another one of my pet peeves. I do not understand why they allow them to talk,
which never happened under
Greenspan.
Greenspan.
I think it happened a little under Bernanke. I think that Bernanke was part of the move of this openness, which I think is just bullshit. I don't even think they should guide.
It's like peak openness right now.
Yeah, and it's stupid. I think it's dumb. I think it's a dumb policy. I don't understand the attraction to allowing them to talk. I understand their arguments for it. I don't think it works in the real world.
Right. Especially when you have 5 or 6 talking the same day.
Yeah. It was 7 the other day. There was 7 of them talking. And you know what the other interesting part is that I've really found that different market participants understand Fed policy and Fed talking a lot in varying degrees. So if you go look during the period when Powell was raising aggressively, there was times when he came out and did something, and I would go talk to my STIR, which stands for short-term interest rate trader friends, and they would all be like, the move would happen and their market would be unched. Like, it would be completely, there would be no change. Like, it would be exactly what they'd expected, right? And then meanwhile, the stock guys were losing their mind and they just didn't understand it. And I can't tell you the number of times I found my STIR buddies going, I don't understand you equity guys. Like, he told you he was going to do this. He told you this. He told you that. And so I think that a lot of times, if you go look at my STIR buddies, they know when Bullard speaks to not listen to him. Like, he just gets discounted. Like, really,
I don't think he's a voting member anymore anyways, right?
Yeah, but even if he was voting, he just they know there's 3 of them that really, really matter. And this is, I've learned a lot from my STIR folks about like how to do this. So it's Powell, obviously. In the old days, it was Brainerd, and whoever is going to replace Brainerd as the vice chair is going to be important. And then Williams, who's the head of the New York Fed. So when those 3 speak, you listen. And you listen for signals, you watch for them. And there's no doubt that when Powell goes out and he tells you something, and if he guides the market and changes expectations, that is a signal. But the trouble is that a lot of traders, especially the non-STIR traders, can't differentiate between Powell changing forward policy guidance, like subtly. He doesn't do it outright. He just kind of hints at things, versus Bullard. So Bullard says something and then they go, oh my God, look at this and blah, 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 blah. And they're like changing things, but then it doesn't happen. So you just have to remember, like the George Orwell, that like all pigs are equal, but some pigs are more equal. That's what you got to remember about the Federal Reserve.
So let's pretend that they hike 25 basis points at the next meeting. Obviously there's things that could change that, like another banking crisis, but I don't think that's going to happen. The bank earnings have actually been pretty decent. Do you think Powell, either in his prepared remarks or statement or the Q&A, signals that they're done? Or
that's a great question.
And then how would the market react? If he signals they're done, does the market say, oh shit, we're slowing down pretty fast? He sees.
No, I think the market gets bought.
Okay.
So I definitely think the market gets bought if he says we're pausing. I think that the market goes, because I think that the market is very much underweight risk assets. You go look at all the investor surveys from these institutions.
I think hedge funds are more short now, right? More short than they've been in a long time.
It's across the board. No matter what you look at, risk is way down in expectations. Like literally everyone expects there to be a recession like any day now.
Right.
So I think that it's actually, if he pauses, the market rips higher is my guess. Now, does he actually pause in terms of saying it out loud is a better question. If I were him, I definitely wouldn't. I would just keep my options open. The question is, by even just keeping his options open, are they going to read through it anyways? Like, I think the market might assume this is the last hike, regardless of what he says. So almost like the market understands it. So I don't know.
Because I think is it May 3rd, the next FOMC meeting?
Yep, May 3rd.
And then you have the jobs report,
on the 5th. That's right. Yeah.
And then I don't know. I assume the next CPI report is probably the week after that. So he may not have that data to use. So he may not want to front run that data. It'll be interesting. I'm curious because hedge funds. I mean, could that create like this melt up trade? I suppose into year end.
Oh, I completely think that that's a possibility. I'm not predicting it, but I was curious the other day. I'm old, but I'm not that old. I was listening to New Order and Depeche Mode albums in 87. I wasn't trading, but I went and looked back in 1987, and it was the stock market went up. I can't remember what the number is, like 29%. Or 30%. It was some big number between January and October. And not only that, the interesting thing was the bond market went from, I can't remember the exact number. I think it went from 7, like the 10-year went from 7 to a 9.5, meaning that the stocks ripped all the while bonds ripped in terms of yields, like went down, got crushed. And the really interesting thing about this is everyone says, oh no, well, if bonds are getting crushed, then multiples are going to compress, meaning like what you pay for the earnings multiple. I went and looked at that. It was basically the same. I can't remember exactly the numbers, but in 1987, it was trading at 18 times of, earnings, and it went up to 22.5 or 22. And if this thing, like, this is a possibility that could happen this year. Traditionally, the third year of the presidential cycle has always been up. An interesting fact, post World War II, there has never been a third year of a presidential cycle where the stock market has declined.
Wow. Really?
Yep. 1987 came really close, and everyone thinks, oh no, 87 must have been one. And it wasn't, because it had ripped so much beforehand and then it rallied back up.
Wow. That's pretty impressive. I mean, and I do think it's possible we've seen all of our gains for the year. I mean, I could see these markets going sideways for the next 7-8 months as we all brace for a possible recession. And if earnings are flat this year, isn't 18 or 19 times earnings on SPX a little too high? Or is everyone willing to look forward to 2024, expecting, earnings to, reaccelerate? And I don't know.
So here's the problem I think that I'm increasingly having when you start talking about the stock market as a whole, is that we have those FANG mats, like those top 6 tech stocks that are such a large portion. Like, I can't remember what the number is, but I think that those 6 are
25 or 30%, I think, right?
Yeah, they're like just monstrous. So I worry, and I have been bearish on those things for a while. I got really bearish in 2022. I actually was lucky to get it right. And I've stayed bearish. Unfortunately, I got that wrong. I did not expect the ripper and these things that we've gone. And I still contend that those things are in a bear market. I really do.
And expensive. I mean, Apple.
Yeah. So yes, I think I completely think so. Do I think So do I think that there's some stocks in there that get really crushed? Absolutely. And I worry about what this is going to do to the index. Like if we have a situation where those 6 get absolutely hammered, but then everything else is bid, we could just end up nowhere, just to your point, right? And so when people say, this is what you're paying for the market, is that fair? And I go, well, I don't know, because I got to figure out like how much I'm paying for, Microsoft and Nvidia and all that crap and Tesla. And I would almost be more interested in the median stock, or if you looked at the S&P as an equal weight index.
Right. So
and actually,
RSP is the equal weighted.
That's right.
S&P, which I follow. Yeah.
So I'm glad you follow that. Not enough people actually do follow that. And one of the most interesting things, and one of the, as I mentioned before, I don't think there's any free lunches out there. Like if somebody tells you something, a lot of times it's just like, it's not that easy. But I do believe that equal weight indexes are one of the few advantages that non-institutional traders, investors can take advantage of. And kind of my caveat to this is, when someone tells you it's not that easy, I'm going to now tell you why it's so hard to own these things. Okay. If you look at the weight of the performance of the equal weight over long periods of time, it beats the cap weighted. And if you go look, I think it's AQR, but maybe it's the other one. Maybe it's Arn's company did a big study. Affiliate Research did a big study, and this also occurs over the entire world. There's like, if you go look at equal weight versus cap weighted, it is something that wins out over time. And the reason, though, is and all of that, I think it's slightly less volatile as well. And if you just think about it, like, it makes sense. You're continually selling the winners, buying the losers, in terms of like reweighting them. So you're not getting stuck with the Tesla at $300. And, as it went up, they sold more of it and bought the cheaper stock. And the reason that this exists, though, and this is the important thing to realize when you go buy this, is that there are months, quarters, and years where it underperforms. Many, many years. And we are actually in one of those periods where it is underperformed by the most that it has ever underperformed. Because, as we said, those 6 stocks have just crushed on the upside.
Right.
Because
this year, Nvidia, Tesla, Meta have all had monster years to date. Yeah.
So now the thing about it is, if you're sitting there and you're California teachers or whatever, and you're a pension plan, first of all, you can't invest in these equal weight index because you're actually limited in terms of the liquidity. Because if you're trying to buy size, and you're trying to buy just as, like, the beautiful thing about a cap weighted index is that the amount you want to buy is directly proportional to how much there is. So you in an equal weight index, you're buying just as much Apple as you are the 500 stock, whatever the 500 stock is. And so when you're, California or pension or whatever it is, you couldn't do it. You would literally wreck the market doing it. So they need to be cap weighted. The other thing is, because this is their benchmark, they can't have 2, 3, 4 years where they underperform.
Right.
So between those two kind of constraints that are artificially placed on institutional money, you as a long-term investor have none of those constraints. So I suggest, wherever you live, whatever market you have, go look at the studies, go try to look at it, and get yourself comfortable so that you're not going to get shaken off if it goes off for a year or 2 years that it underperforms. And if you agree with the studies and you agree that equal weight outperforms market cap over time, then you should be putting those things into your retirement accounts.
How do you hedge your portfolio, or do you worry about hedging, or if you're bearish on every asset class, would you just sit in cash, or are you always looking for something to buy?
So I probably trade with too much leverage. So I'm very rarely like in cash, because I would have lots of different positions. And like, the real trouble is, like, if I go and bet on like 3 month, like if I went into bet on what we were just talking about in terms of Powell's policy rate, I would go trade like SOFR futures, which is like the front end future. And I would, to actually make a difference in terms of a portfolio, in terms of volatility, just I may trade like 1,000 per notional of my account. So when someone says like, what leverage you use, like it's not really important what leverage you use. To me, it's more about what volatility you use in terms of how much vol are you prepared to go up and down. So in terms of, I'll just talk to you about how I manage risk. So over the years, kind of one of my biggest failings, or not, I wouldn't call failings, I guess mistake that I consistently make was, I remember reading in Market Wizards about, I think it was Druckenmiller, but it might have been someone else who talked about how he would chip to getting up 40%. And then after being up 40%, he would really go for it so he could get up 100%. And that was it. So he'd go for it. So my thing is, I'd chip to get up to 40%, and then I'd change my trading and I'd give back the 40. And I was like, so over the years, I've kind of learned that I'm like, shit, I'm no Druckenmiller. So I'm going to I'm going to chip. So I'm a chipper. And that's like, I'm using a lot of volatility, and but I'm definitely chipping. I'm not going to go, and I don't want to be as lumpy as I probably am, but that's the long and short of it. But the one thing I've learned is that because I'm using a lot of volatility, and because it's hard to say, how are you overexposed, underexposed right now in terms of your risk. I'll say, like, let's say I'm used to 200 basis point days. Okay. Meaning if I'm up or down 2%, I can live with that. Then all of a sudden, let's just say I have a 400 basis point down day. I'll be like, oh shit, that's bigger than I want. I got to start reducing. Okay. And that's easy. Like once on the downside, that's super easy. You do that. Now, what I've learned kind of just through like stupidity and just doing it over and over again the wrong way, I finally realized that when I start to have 400, 500 point up days, and it doesn't really matter what the absolute numbers is, it just matters versus what I'm used to in terms of my volatility. When I start having those big up days, I also reduce it. And the reason I reduce it is because if I'm used to 200 point up days, the 200 basis point up days, and all of a sudden I have a 500 and then an 8, and then like, let's say a 400, and I'm up 900, it's really easy for me then to go and to give up half of that. So I'm going to now move 450. But the thing is, when it goes 450 on the downside, I'm actually only used to 200 basis point up, 200 basis point moves. So I get all freaked out, and it's just too much volatility. So what I've learned is that I like to kind of maintain my volatility both ways. And I know that goes against a lot of people that say, oh no, you should let your winners ride and things like that. I just can't do it. It's not the way I trade. And it's just something that over the years I've learned. So for me, most of my stuff is based upon my risk in terms of volatility. And then when I get into periods when I feel like there's less opportunity, like right now, I think that there's less going on that's really juicy, I'll just dial it down. So my volatility will just come down, and I'll be like, instead of, 200s, I'll be looking at, 50s or, whatever the number is.
What's the best way to play the VIX? So I made the mistake a couple of weeks ago. Once the VIX got back under 1850 or 18, I forget the exact number, I started buying that stupid ETF UVIX.
Yeah.
And it does not track the VIX at all. It's been horrible. I'm down 20% on it. I thought it'd be a hedge. It really hasn't worked for me. So, I mean, either way, I'm still up 33% year to date in my portfolio, so I'm not crying over it. But is there a better way when the VIX gets down into the mid-teens, and I think it's time to start buying the VIX, in case we see one of these spikes, what's the best way to do it?
Okay. So you said that the UVIX isn't tracking the VIX. No. It actually is tracking what they said they're going to be tracking in the prospectus. But if you go look at the prospectus, it's not tracking the VIX cash index. It's tracking the VIX futures.
Well, and I think it's longer term futures too.
Yeah. And it's just that the reality is that those indexes, apart from when there was a little bit of problems with the VXX, when Barclays, I think, got into trouble with their prospectus, but otherwise they track the indexes perfectly. The trouble is the indexes aren't the VIX. So that's the first thing you should understand. You're not buying the VIX, and there really is no way to buy the VIX. It's not like, you can't really do it. So now the next question is like, what's the best way to do it when you want to trade that? So I think that 99% of people shouldn't trade VIX. And then the other 1% should probably really look themselves in the mirror too. It is a tough.
I'm in the 99%.
It is a really, really difficult product. And if you just pull it up over time, like go pull up a chart and put, one of the ones that have lasted and look at the decay and look at the
I mean, the only time to really own it is if you get one of these Silicon Valley Bank situations. This thing spikes up 50, 60, 70% in a week, and then it comes crashing right back down. So.
Right. You'd probably be better off if you're worried about the market. You'd probably be better off going out and creating an option trade in the actual S&P that
like a put accurate spread, call spread.
Yeah, a put spread that you want to buy that you think that accurately reflects the kind of your worry about how much you think it'll go down. So like, it depends on what you think. Are you just expecting the S&P to drop 10%? Like if you're just trying to hedge, the S&P drop in 10%, then you go out and you buy a put spread, like an at the money S&P put, and sell it at 10% out of the money put. Okay. And you actually have skew working in your favor, meaning that the volatility that you're buying it for is a lot less than the volatility that you're selling the lower strike for, because as you go lower in strikes, the implied volatility goes up. So you have skew working in your favor, and you can do it that way. And yes, if there is a minus 40%, you're not going to participate, but so be it, and you'll know what your loss is. You'll know how it'll decay. The VIX is not only it's based upon people's belief about what forward implied volatility will be. Like it's such a complicated Frankenstein of a monster, and I think too many people go to it and trade it thinking that that it works. And I think that you talked about those spikes. That is why it works so well, and why people keep coming back to it, is because when it works, it just works in such great thing. And that's also why shorting it is difficult. Interestingly enough, I actually spoke, did I speak to him or did I hear it? I can't remember, but the guy who made the VIX is this Canadian professor that moved down to the States. And I'm pretty sure, if I don't want to put words in his mouth, but I'm pretty sure he consistently owns puts on the VIX, and meaning that he is constantly short it. And the reason he does it through puts is because he wants to limit the those spikes. He wants to know that he can't lose any more than the cost of the put, right? Because that is the scary thing, right? When the VIX goes and just explodes higher on you, and it goes from 20 to 40 overnight, and it gets crushed. But anyways, long and short of it is, there's probably better ways to hedge yourself than to buy and trade the VIX.
Yeah, no, I've learned that lesson the last couple of weeks the wrong way. So I didn't own UVIX going into the Silicon Valley Bank collapse. So I guess if I missed, and I didn't buy it until that whole thing was over and the UVIX was back down, but it has not worked for me. Any parting words for us? What do you think of these markets right now going into Q1 earnings? Do you have any expectations for which way we're headed coming out of earnings?
I think that the interesting thing about earnings is that it hasn't been as bad as all the bears thought. I kept hearing how this was the earnings cycle that was going to show how bad the economy is. I talked to a guy that is a hedge fund manager, and he goes and he phones companies all the time. And he keeps saying, I don't understand why everyone thinks the economy is about to roll over. He says, apart from office REITs and some regionals, the economy is white hot. And it's kind of baffling, and it's kind of interesting how this recession has been the most anticipated recession ever
for over a year now.
Yeah, and it's just it's shocking because it's frustrating for the folks that are saying that it's not going to come, because even though they've been correct in their call, the market's still pricing like it's going to come.
You think we'll see unemployment in the 4s at any time? Any point this year or even next year?
I don't know, because I'm not sure about those about the tech guys. Like my problem is I believe it's such a bifurcated economy, meaning that I am super bearish on all the tech dream stocks, all that crap. I think that stuff it's in a bear market. It's going to continue for a long time.
Kathy Wood stocks.
Yeah. And I think that's those are bear market for a long time. I was around during the dot-com bubble. I remembered how everyone kept trying to buy tech after, and that's never the area to own in the next part of it. And to me, the fact that everyone's rushed back into it this time has been the kind of the thing that I've gotten probably the most wrong in the last 3-4 months. And I just feel like it's not over yet. And it's just a bear market rally in those tech names that are going to squeeze everyone. So like when you're asking me about employment, I think that if you have, if you can go and roof a house, you're going to have no trouble getting a job. But if you have, if you're trying to be a programmer, you might have some more trouble. Like it's going to be a real different thing. And I guess that goes back to my thing about when I talked about monetary over fiscal. One of the things that's occurred over the last little while is that really the last 20 years has been Wall Street over Main Street.
Well, and that is, this could be a white collar recession.
Yeah. And I think for many reasons that this is going to be the decade of Main Street over Wall Street. And the real challenge will be, how do you play that in your portfolio?
Yeah, because it seems like a lot of the layoffs that you hear about are the big tech companies. It's not a lot of the, like I know Whole Foods just did a small layoff, big deal. I forget which other company's doing them, but you don't hear about them in a lot of industries outside of tech.
Yeah, because they're smoking hot, like it's white hot.
Would you buy energy here?
Yeah, I think that energy is a long-term hold. Like I think it's something that you need to own. One of the interesting things about this whole move to electrification is that I think that we've missed that actually going green takes more energy, meaning that there is the building of the infrastructure is going to require more energy. And the continued demonization of the fossil fuel companies is just mind-bogglingly stupid. The selling of the SPR, I think I could argue that it was ballsy. I wouldn't have done it if I was him. I get why he did it. I'm shocked that he came back to his price and he pulled his bid. It was like
they should have started filling it again a couple years ago.
It was such an amateur move. Like it literally was such an amateur move. He had his order, like he's in there, and then it came close to his price. Like he had a short position. Like you could think about him. He's short. The US is short oil. And they had their price to, that they were going to get it back in. And once it got there, they pulled their bid. And
then OPEC said, screw you.
Yeah. So I think that,
you think oil goes back? Where is it? Is it still above 80? I didn't look at it today.
Oh, I think oil's headed a lot higher.
Yeah.
Yeah, I think oil's headed a lot higher.
I mean, in full disclosure, I just started a position in Oxy today. It recently pulled back, bounced off of I forget which moving average it bounced off of today. But, at one of these days, we could wake up and Warren Buffett could just buy the whole damn company. He already owned 20%. So.
Yeah, that's true. Yeah, I know. I think that the longer term, the market, the energy market has been starved of capital, and it's going to result in prices being higher and the returns of those companies being higher for longer than people think. It's kind of like the cigarette stocks. Like it'll be shocking how well the stocks continue to do.
So oil's pulled back. Oil's down under $78 right now. It was in the low 80s a couple days ago. So, I mean, that probably explains why some of the energy stocks, the oil stocks have pulled back in the last few days. But yeah, I agree with you. I mean, these companies make a ton of money. They pay dividends. They buy back stock. Well,
the other thing is, Jonah, that they go, and this is a recession trade. Like if you're a hedge fund and you're sitting there going, I think the recession's coming, the traditional trade is to go and you short oil stocks. Like that's what you do. Like that was it. So I think there's a lot of folks that are leading that way that have the recession trade on. And if it doesn't occur, like if we don't roll over, we don't have a recession tomorrow, they're going to be like, holy shit, I didn't expect this. And all of a sudden oil will ramp.
last question. If we,
Yeah.
what is a good recession trade? Or historically, if we go into a recession, what assets have outperformed in a recession? Is it the hard assets like the gold?
No. So, well,
estate?
okay. So here, this is actually a great question again. I think that in the past, like if you go talk to the real big hedge fund managers and you look at where they made their big money, almost all of them made it by betting on lower rates, like the Fed to cut rates. And so they own 2s or 5s. You know, there's the famous story about Paul Tudor Jones. He made all this money being short the S&P 500 in 1987, but he also was long, you know, out the yin yang 5-year treasury futures. So traditionally, they've made tons and tons of money by assuming that the response will be to cut rates. And I think that that's partly why you've already seen a situation where the curve is inverted, because I think that people are worried about a recession coming and they're going and they're front running it by going out and getting ahead of that. I don't know if that's going to be as good as it has been in the past. And one of the things that I think is a better way to play it is I've actually become, you know, a big gold bull. And the reason I'm a big gold bull is that I think that when the West confiscated Russian reserves, meaning dollar reserves, US dollar reserves, they changed the dynamics of the game. Up until that point, even your enemies could count on having money in US dollars would be safe. Like, you know, they would be there. Then all of a sudden you're sitting there and Russia's sitting there and they can't get their bread. Like they can't get it. If I was China sitting with the largest, you know, reserves by miles, okay, with only 3.5% in gold, it would be irresponsible to not go and start shifting some of those into gold.
Now they're buying like the actual gold bullion, right?
Yeah, but I think the only argument I can see that why they wouldn't do it is because the market isn't big enough for them and it's not worth their hassle. But like I still think even then I would still do it. So if I was China, if I was giving the Chinese, you know, People's Bank of China, you know, advice, I'd be like, you got to start just diversifying out of US dollars and you have to start going in. And to me, the only thing you can really do is buy gold.
Is China still our biggest creditor?
I think Japan buys for it depending back and forth, but it's still huge. But the point is that as geopolitical tensions ramp up and as the world changes, and by the way, we didn't really talk about this, but that's another reason I think we're going to have more inflation, is that we had globalization for the last 30, 40 years with China entering the WTO with the fall of the Berlin Wall. And that's all going in reverse.
Are we going to have deglobalization now?
Oh, yeah, 100%. It's already happening.
You're seeing more onshoring of stuff away from China, right?
And it's already happening. And that's inflation positive. So,
probably good for our jobs, right? It'll create more jobs in the US, but it's good. But we're going to import more inflation.
That's correct. And the other thing is that over the last, you know, I talk about this Main Street over Wall Street. If you go look at the last 40 years, labor share of the GDP has consistently declined while capital share of GDP has risen. And the reason is that, like, if labor went and asked for a raise, they said, well, you know, you're just lucky you have a job. I'm going to, you know, send you off. I'm going to send your, you know, make this in China soon. Well, now we have the opposite. And so now all of a sudden labor can ask for more. And that's another reason from the kind of the longer term why you could be worried about stocks performance and that it probably won't match what we've had for the last 20, 30 years is because that gain that we've experienced through capital winning over labor is going to reverse. But back to gold, I just think that China's going to be on the gold bid for years to come. And I look at it and I think that that's probably at least as good a play as owning some short dated paper, like betting on lower rates.
So how do you play gold? Do you just keep it simple and do GLD, the ETF, or?
I do it a variety of different ways. I'm just long futures. I'm long silver, but I do have as well. The GLD options are great because they're extremely liquid. they're listed on like the traditional equity market, as opposed to like when you go try to buy gold future options. They're not as good a quote. Like futures options quotes aren't as like solid in this. It's not like what you get kind of like how it is with the equities. So with the GLD, I go and buy like long dated 2024, 2025 calls. And I generally, this is another thing. I used to get all fancy with my options trading, come up with these sophisticated strategies. And I met some guy that's, used to work at Tudor, and he just says, yeah, when I get bullish, I buy a 30 delta 1 year call. When I get bearish, I buy a 30 delta 1 year put. And I realized I went and did all the math on my stuff. And I was like, you know what? My stuff doesn't behave that much differently than his. I think I'm just going to do that. So I've increasingly started to just do that. When I get bullish on a long-term thesis like that, I just tick away like some 1 year, 2 year calls, and I have them. And the thing about those is that what I like buying that is that you limit the theta decay. Like that kind of decay that you get from time, it's a lot different on a 1 month call than it is on a 1 year call. As you approach the kind of the expiry of the option, the theta decay increases.
If you're buying 1 year out, do you continue to roll them every few months?
Yeah, so maybe at 6 months I might roll them, or I'll just add to them. I don't know. It depends on how it goes. The one thing I will say is that, we talked about the skew on the S&P, and how the skew is like you get more, it's more expensive to buy an out of the money put than it is to buy an at the money put. In gold, it's actually the opposite, meaning that the skew to buy a way out of the money call is higher, meaning like the implied volatility is higher. So it's tempting to go and to buy an at the money or slightly out of the money call, and then sell those kind of fat, calls that are way out of the money. To me, I'm not doing that. I used to do that. I kind of think that if I have an environment where it all of a sudden just goes bananas, that I want to make sure I have it. Yeah. And especially, like that's one of the greatest changes that occurred in 2021 or 2020. It was that kind of realization that right tails can be way bigger than ever before, like with the GameStop and stuff.
Oh yeah.
That is, I don't think that enough people understand how truly profound that was, and how unusual those moves were, and how unique that period was.
It was parabolic is an understatement.
Yeah.
Where's the best place to find you online? I know you're on Twitter pretty often.
Yeah, I'm trying to cut down on my Twitter. So if you want, go if you're interested, send me an email if you want to get some kind of examples of my letter. I'm more than happy to send some off. Kevin@themacrotourist.com. And if you are on Substack and you want to come chat with our group, there's a group of us that are, there's a little kind of mini, I call it almost like a trading room. You can just go to themacrotourist.com/chat, and that'll take you to the Substack chat.
Oh, cool. Okay. I actually haven't started using Substack chat. Have you found it pretty valuable?
Yeah. So I really like it. And as I say, there's a chat that we have that's specific to my kind of folks. There's another one that they call Notes, which is in essence just a Twitter, kind of clone. I'm not as keen on Notes. It's like I got on there the other day and I was like, oh my God, all the problems that Twitter has about people attacking other people and stuff has already started to occur. So for me, I just like the chat, because it's people that just want to learn about the markets and share ideas. And, someone came into our group the other day and said, what are the rules? And I said, there's only one rule: be kind. And that's it. And everyone seems to be doing that. And it's terrific. And it's really great.
Cool. Good to hear. I might have to start using it then. Kevin, thank you so much, man, for your time. Really appreciate it today. I know it's a Friday, now 4:00, markets are closed. So enjoy your weekend.
Thanks, man. It was great chatting with you. Take care. Bye-bye.